one of our guiding principles is to stay informed but ignore the noise. That means that while we recognize it is important to keep abreast of what's happening in markets, we also believe that investors should be mindful of resisting the urge to change their long-term investment strategies solely in response to market volatility and noise. We know, however, that financial markets can often be unnecessarily noisy and complicated. With so many headlines clamoring for our attention, it can be hard to keep up with what's relevant and what isn't. But don't worry, InvestNow is here to help. Each month, together with one of our expert fund managers we have on our platform, we'll distill the key events in the wide world of investment into digestible bites curated for the Kiwi investor. Today, I'm joined by Ryan Fors, Senior Analyst at Mint Asset Management, one of the leading fund managers we have on InvestNow. Ryan is a qualified actuary and looks after Mint's diversified funds and joins us today to help break down an eventful start to the year in terms of markets over January. Ryan, thanks for being here and hope your year has gone off to a good start, mate.
Thanks, Jason. Thanks for having me. Yep. Looking forward to it.
Nice. Let's kick into the January market wrap-up then, shall we? As it's really been a busy start to 2024 in markets. So, Ryan, with January in the rearview mirror now, we've got this market dashboard here, which handily summarizes the recent performances of a few key indices, like local as well as global bonds and shares. So we can see that equity markets were modestly green over the month, while fixed interest struggled a bit more. Were there any pockets in the market here that stood out to you over the month?
No, nothing specifically that I want to draw on, but I guess the keynote to note here is that obviously equities had a positive month, whereas fixed income had a flat to slightly negative month. So a bit of a divergence between the two major asset classes in January. The only other thing I would kind of call out here is that New Zealand and the NZX 50 has underperformed kind of global shares. So looking at US and global there. We see that probably as a reflection of the kind of sector makeup of the NZX 50 relative to the other indices globally. And I guess the lack of tech weighting within the index driving kind of results.
Nice. So let's dive a bit deeper maybe into the strong equity markets we've seen recently. It's worth highlighting that over the month, we saw the S&P 500 finally notch a new record high after a 2-year wait. So the last record high was the first trading day of 2022. And then we kind of all know what happened after that. It's basically been disastrous over that year when the index was down over 20%. Since then, though, we've seen the S&P stage a remarkable recovery. Ryan, could you maybe give us some insight into some of the main companies or factors that drove this rally and seeing us back into the record highs?
Yeah, I can do, Jason. So just noting that equity markets are coming off a very strong end Q4 23, as you can see in this chart. And they continued that strong march upwards in January and beat the all-time high, as Jason, you've mentioned, and then also surpassed the long-awaited 5,000 mark. From the outside, it looks like equity markets appear to be pricing in a perfect soft landing scenario where inflation comes down in an orderly manner, with the growth and margins holding up. And then rates obviously becoming more accommodating into 24. However, as I mentioned previously, bond markets diverge from this and they appear somewhat less sanguine about potential for rate cuts this year. As the fixed income market experienced several head fakes, I would say, during January with some volatile macroeconomic releases coming out, such as hotter headline CPI, some dovish notes from the Fed, a sizable miss on PPI, and then finally the advanced GDP coming out of the US, still strong and positive, around 3.3%. So the US still showing no signs of slowing down. Market pricing for interest rate cuts reacted accordingly, but I'll touch on that in more detail in the following few slides. I guess turning to the next slide, everyone likes to comment on the current market breadth, or current breadth of the market rally. I'll say for free that it hasn't been easy for active managers, as a lot of the gains are concentrated into a handful, aka 7 names. Given their outsized weight in the index, it means that any dispersion against the benchmark is somewhat amplified as they continue to outperform market cap increases and they become an ever larger part of the index. We know that passive investors effectively have reduced their overall portfolio diversification as a function of this, and these names take up ever larger increased positions within their portfolios. However, for us at Mint and other active managers, we try to ensure diversification rather than piling into a handful of names and increasing the overall risk to you as the end investor. So to that end, I will hope for a broader market surge rather than the Magnificent Seven coming down. I guess in terms of individual standout names, one name on everyone's lips for the last year has been NVIDIA. So it's obvious standout. It continued an absolutely stonking run in 2023 in January. So it's up another 25% for the month. So yeah, no small feat. Outside of the Magnificent Seven, we have AMD. So it's one of the names in our fund. And it actually has continued to post equivalently stellar returns for January and also from last year. So it's up over 100% from 2023 and up 13.8% in January. And this, I guess, reflects some wider market optimism around the continued supply on specialist AI hardware, around GPUs and chips that are needed for the surge in that sector going forward. IBM, even a competitor to AMD, has also seen a strong January, so it's up 12% for the month. And I guess, as the old saying goes, a rising tide lifts all boats. I guess I broaden the discussion outside of tech and AI. We have seen some big winners in the form of healthcare and pharma companies who have very highly publicized weight loss medication being sold. So we have Novo Nordisk, which sells Ozempic, and Eli Lilly, which sells Zepbound. They're up 49% and 59% since last January in local currency terms. So yeah, they're outside of the AI theme, they're one of the other main market themes that have driven the rally this year, or sorry, the end of last year. In terms of the actual sector split, information technology or tech has contributed the most to the overall growth in S&P earnings in Q4 23. This is due in part to their steady earnings and continued strength, but also more to do with the outsized composition or weight within the index. In terms of actual individual standout sectors, consumer discretionary and utilities posted the highest earnings growth in Q4 23. So just to note that earnings growth is not solely limited to tech. There is a strong US growth picture out there, and it does appear more broad-based than what the market rally implies. And I guess one thing to note for me from the bond side is that this rally in US equity markets didn't really get a solid footing. We had a few false starts last year. And I guess my view is that it didn't really get that solid footing until the market view for the path of interest rates kind of somewhat reached a consensus. So this is around obviously Q3, Q4 last year. And obviously that coincided with the rally in equities that we've seen. The consensus was around where the peak in the cycle was, and then I guess the narrative shifting from higher for longer to when the Fed or the other central banks are in a position to cut. And we note that obviously the Fed's preferred inflation measure, core or PCE deflator, came in back to target in 2023 as well. So that helped the market reach consensus and where rates are going, and that helped drive equity markets.
Yeah, I think we definitely saw a lot more of a broader rally towards the end of the year than we saw for most of 2023. So fingers crossed, hopefully we do see a bit more of that, because I think, to touch on an earlier point that you raised, I think diversification is essential, and it's one of our InvestNow's kind of key principles as well. So it's great to hear that Mint shares a similar view, because it makes a lot of sense that, obviously put all your eggs not in one basket.
Yeah.
But cool. Thanks, Ryan. That's been super helpful and insightful breakdown. Maybe turning to key events that are closer to home for the Kiwi investor, who have had a couple of key data releases recently that will be relevant to shaping where the New Zealand market heads next. Unemployment, for example, in New Zealand rose 4%, which followed recent historic lows that we saw kind of in that 2021 to 2022 kind of post-COVID era. Ordinarily, more people being unemployed in the country doesn't necessarily sound like a good thing. But Ryan, could you maybe walk us through how this could actually be a boom for New Zealand market?
Yeah, you're absolutely spot on there, Jason. Like, it feels perverse to talk about a significant miss to the downside on unemployment as a negative headline. Historically, it'd be like more people having more jobs equals good thing. But I guess this is more a reflection of the market cycle we're in and where we are in terms of the rate cycle. So markets had penciled in roughly 4.3% year-on-year number for Q4. RBNZ forecasted 4.2. So this 4% number, we can see in the chart, was received quite negatively on the day. Yields kind of went up. The reason being that the market's seen this print below RBNZ forecasts, and it forces participants to ask themselves the question, what does a relatively and loudly hawkish RBNZ do in the face of this unemployment miss? Now, what will give some of the dovish market participants some level of reassurance is the private sector labour cost index, the LCI, came in at 3.9% year on year. So this is your wage growth measure. However, we do note that there was a volatile, slightly more volatile series. The QES private sector earnings came in still comfortably high at 6.6%. Now, the reason RBNZ care about unemployment is that it affects the level of slack in the labour market. The less slack, the hotter the labour market, and then higher wage pressures naturally follow as businesses have to compete for a finite pool of talent. And it ends up being that the workers have more power in any eventual wage negotiations. Now, the reason RBNZ care is a central bank nightmare. It brings back memories from the embedded wage price spirals we've seen in the late 70s, early 80s. And effectively, wage price spirals beget higher inflation expectations. They become bedded in, and then realized inflation follows, and it continues to soar. Now, this is bad for RBNZ, it's bad for central banks everywhere, so they will do everything they can to ensure that that is not the case. I guess, fortunately for RBNZ, there are a number of other leading indicators other than this headline unemployment rate that do point to continued slack and kind of relaxation from the tightness we've seen last year. So just a few ones that we've been kind of watching is the ANZ surveys and the quarterly survey of business opinions that come out. They're noting that difficulty of finding labour has decreased massively from the highs we've seen in 22 and 23. Labour to a limiting factor in production has receded to more comfortable territories and no longer is the dominant factor to limiting production. We also note that there's a job adverts on the Seek website, or the Seek job website. They have fallen off a cliff from last year, so they're down actually 22% year on year as of January. So quite a large drop. It's pretty crazy. I guess in addition, on the Seek website, we see that the number of actual applicants per job has been increasing quite steadily, and that obviously points to less slack in the labour market and less jobs for people to chase if more people are applying for the same number of jobs. And I guess the last kind of missing piece of this puzzle, which is kind of the big piece of the puzzle, net migration to New Zealand is still at near peak levels of around 127k. So this influx of migrants should only increase. It's only accelerate the increase in the unemployment rate we see, as New Zealand Incorporated cannot create enough jobs to match that influx. So just thus increasing the size of the labour force and increasing that unemployment rate. Our view from here is that whilst this was a disappointing miss, and I say again disappointing in the perverse sense, disappointing miss from a rates perspective, we still strongly believe that unemployment will increase from here, given all the factors we just mentioned, and could increase to levels above 5% and above NAIRU, which is the non-accelerating inflationary rate of unemployment. So that should be conducive to the RBNZ being in a position to be able to lower rates sooner rather than later.
Brilliant. Ryan, excellent breakdown. So I guess the key kind of message there is that even though increasing unemployment may seem like a bad thing on the surface level, it could actually be quite a great boom for New Zealand markets, especially with the RBNZ having a meeting coming up to decide, the fate of interest rates. So one kind of key piece of data that they'll also be deliberating through is obviously the recent inflation figures, which finally retreated under 5% in the most recent December quarter, notching at 4.7. So first time under 5% since late 2021. So Ryan, any views on what the RBNZ might be thinking as they head into their first meeting of the year in late December? And have they done enough to tame the inflation beast? Can Kiwis expect to see some cost of living kind of relief through interest rate cuts anytime soon, or do you kind of see the RBNZ having another hike in them sometime?
Yeah, well, I personally would love relaxation and cost of living increases, but I guess, good news is that we're below 5%. As you can see from this chart, it's coming off quite a high peak from 2022 and 2023. On this latest release itself, so the CPI print came out at around market consensus of 0.5% quarter on quarter and 4.7% year on year. So for everyone within this release, there was something for everyone. So the headline print came in lower than RBNZ forecast at 5%. But within the actual detail, the non-tradables basket still came in slightly too hot relative to forecast. So it was 5.9% versus the RBNZ forecast of 5.7%. Now, the reason that RBNZ make explicit reference to non-tradable inflation and why market participants pay so much attention to it is RBNZ believe that non-tradables inflation represents the relative like the relative supply and demand constraints within the economy, whereas tradable goods and services simply reflect the change in international currency and FX rates, and then the competitive price of goods internationally. Now, so for that reason, New Zealand, we're a smaller import-focused nation. They are keen to get a handle on that non-tradable basket because it could be a source of embedded sticky inflation going forward. Now, that sounds all doom and gloom, but we have some interesting comments from some of the research coming out. So one of the banks actually mentioned that RBNZ focus very heavily on this non-tradable basket of inflation, but noting since the turn of this century, the non-tradables basket has actually averaged 3.4% year on year compared to the tradables basket of 1.4%. Now, if we remind ourselves, the target range is 1 to 3% for the RBNZ's inflation target. If we think New Zealand has historically run that basket higher, that non-tradables basket higher, so 3.4%, so it's above the range. Tradables have pulled it down. So we and other market participants are, I guess, wondering is, will RBNZ continue to be dogmatic on that number, holding up the kind of monetary policy story? Will that be the reason that they refuse to cut or eventually even hold for longer, or worst comes to worst, hike? The thing I want to note, and the thing that I think is important, is that RBNZ's mandate isn't explicitly to target certain parts of that inflation basket. What their mandate is around the headline number, the headline CPI. So we believe that if the headline comes in back in the target range, then the composition underlying it isn't going to be a driving factor in the monetary policy decisions going forward, especially if the headline number stays within target range. And I guess one other thing to note is we at Mint aren't as concerned in that stickiness of that non-tradables basket, because we can see evidence globally of disinflation, and we are of the view that New Zealand will follow, maybe albeit at a lag, but they will follow the global disinflationary forces. And I guess this is reflected in our long duration positioning within our funds, within the fixed income part. And because we're trying to benefit from that eventual yield compression as central banks, including RBNZ, are in a position or have the opportunity to cut as the inflation eventually settles back into palatable levels by year end 24. We are of the view that OCR has peaked, and we don't believe that the Monetary Policy Committee will increase rates in February or April.
Cool. So hold at least for the next couple of meetings, and you reckon probably mid this year, maybe the light at the end of the tunnel.
Yeah, maybe light at the end of the tunnel, exactly.
Cool, nice. Thanks, Ryan. And I guess interest rate cuts aren't only front of mind locally in New Zealand, also more broadly in the US, where many market watchers are eagle-eyed seeing what the Fed does in their next meeting in March. So I know there was some initial optimism early on, just a couple of weeks back, that we may see the Fed undertake their first interest rate cut in March. So Apollo Global Management did note that if the Fed was on track to cut by March, that would be kind of bang on the average in terms of time between the last Fed rate hike and the first cut. The markets haven't been as optimistic recently, have they, Ryan? As we've seen quite a few data releases kind of impact the pricing. So as you're nicely kind of outlined in this chart of the month, could you kind of walk us through what we're seeing here?
I sure can. So this is my story or chart of the month for January, and it is referencing back to what I mentioned in the first slide, that equities and bonds have somewhat diverged in this first month of the year. So as I noted, these equity and bond markets both swooned going into Q4 last year, had a great time, but they've had somewhat of a hangover in January, with investors actually repricing the amount and the timing of interest rate cuts for 2024 in the US. Now, I should just note this is obviously for the US Fed futures market. Why this matters for New Zealand is that US and global interest rates do have an effect on the medium to long end of our yield curve. So we do have a relatively high beta. So if US rates go up, we would expect New Zealand rates to follow suit. So yeah, just on the chart itself. So as at the end of December, this just chart effectively shows what markets are pricing in for the effective interest rate in the future. And then people like me and you and market participants can back out how many cuts then on average the market expects to see. So markets had priced in around 725 bip cuts by year in 24 at the end of December. But then in January, as I mentioned, we had a few hawkish data surprises and statements from central bankers, which had paid to the notion that rates were coming down. at the early part of the year. So we had a hot inflation report in the US, 3.4% versus 3.1% previously, with the shelter component still staying very punchy above 6%. Additionally, with some volatile weekly job numbers and job claim numbers, which markets reacted to, then give back gains to as the month kind of oscillated in terms of releases. And then I guess one of the big ones was the strong advanced GDP measure. So it came out at 3.3%. So strong growth picture. Inflation actually ticked up a little bit. So markets kind of pared back their expectation for a rate cut from March into May, and the number of overall cuts was reduced for the year down to 6. So you can kind of see that by the dotted line around the difference there, so around 25 pips difference in the overall number of cuts for the year end. So just as I mentioned, interest-rate bonds obviously had a somewhat negative to flat month as the yield curve moved up to adjust to this new consensus, but equity markets shrugged it off and continued on their merry march. And this was the initial decoupling I mentioned in the first slide, and different, obviously, equity investors versus bond investors have a different view in, I guess, the soft landing case, the disinflationary case, or the deflationary case, and where, I guess, unemployment and growth goes in general. But equity markets seem to be slightly more optimistic relative to the fixed income markets. But I know which side I would pin my hat to. Being an actuary, I'm going to have to fall on the side of the bond markets being probably more right than what equity markets are pricing at this point in time.
Yeah, so it's an interesting point you kind of touched on earlier. It's almost the good news in terms of these, positive economic releases like GDP kind of overshooting the market. It's actually can be bad news sometimes for markets, right? Especially in the bond market this time round. Obviously with the interest rate repricing, that would have a significant impact on how bonds have done over the month. So maybe Ryan, could you walk us through, what's been happening in that space with your kind of actuary hat on, and where you guys kind of see bonds, relative to equities today and kind of going forward over 2023. Sorry, 2024 now. Yeah.
2024. So yeah, I guess just reiterating what I said previously. So markets arguably got a bit ahead of themselves in December. So you can see from this chart where yields have dropped quite significantly at the right-hand side of the chart. And I guess then January they reversed that trend. So this was widely seen, I guess, as a small market pullback relative to the exuberance we've seen in November and December. I guess at a high level, we expect more interest rate volatility going forward. As these monthly macro releases appear, and some of them are going to be slightly over, slightly under relative to expectations, but we're comfortable and confident that the trend for deflation is going to continue in the way it's been going, and that easier monetary policy will naturally flow off that as a function of the more comfortable inflationary environment. I guess just to touch on our outlook, we've been in the soft landing camp for the guts of a year now, and we still are. We see the chances of a large and deep recession appearing ever more diminished, given the strong growth in the US and the non-negative growth in New Zealand. And I guess the other thing to note is we've seen labour markets ease somewhat, and they haven't actually blew out in a disorderly fashion yet, which is something you would expect around kind of recessionary periods. We do believe, as I mentioned, inflation will continue to fall. Central banks should be in a position to cut rates rather than risk tightening for too long and increase the chances of a policy mistake and engineering a recession. Now, position-wise, this will be positive for bonds as rates fall across the curve, obviously driven by the short end. So that kind of drives our long duration positioning in both funds, both income and the growth fund. Within equities, we are still constructive over the next few months, but we do acknowledge there is potential for market volatility as the growth outlook moderates. We have looked actually to take advantage of low implied volatility levels in recent months to tactically hedge some tail risk scenarios. And that's just us being, I guess, prudent from a risk management point of view more than anything else, because vol is low, so hedging is slightly cheaper. In terms of credit spreads, they still remain relatively tight, but however, defaults appear relatively benign. So we're still bullish on credit risk and don't really see any kind of massive headwinds for that sector going well in the immediate future. And then generally within the equity sleeves within both funds, we believe that our growth and less so, but still important there. Quality bias will help in this declining rate environment. So yeah, we should be well positioned to get any kind of continued rebound in equity markets, and hopefully we then benefit from the rate compression that I mentioned we are seeing or forecasting going forward.
Nice, very insightful. So I trust you are reflecting all this into your Mint diversified growth and diversified income funds that you manage, that we have available on the InvestNow platform, as well as InvestNow KiwiSaver Scheme. Could you provide any insight as to kind of how much conviction you have towards these views, how overweight you are, kind of relative to bonds, relative to equities, kind of thing, or?
I guess well we are significantly long duration in our fund. I guess everything's relative to the respective benchmarks or the duration of the benchmark that you're managing to. But yeah, we are, well, I can't really give you a scale because you're not familiar with our conviction scale, but yes, significantly over is what I'll say. Within equity markets, we are happy if those for tail risk hedging doesn't pay us. That'd be great, because that tells us that equity markets have continued to march on their merry way. So yeah, there's more of a tail risk management point of view for the options.
Nice. Well, great stuff. Well, thanks, Ryan. Excellent insight as always. I think that's probably a wrap on the InvestNow Market Wrap-Up this month. Ryan, thanks again so much for your time and excellent insights. If you want to check out more, you're welcome. If you want to check out more from Mint and all the great work Ryan and his team does, check out the Mint landing page on investnow.co.nz, where you'll find out more about Mint and all they're about, as well as the opportunity to invest into Ryan's diversified growth and income funds, alongside 3 other Mint funds we have on InvestNow. If you want to check out the written version of the Market Wrap-Up piece accompanying this video, check out the link on the screen. Otherwise, thanks, Ryan, and thanks everyone for your time. We'll catch you next time. Cheers.
Cheers.